Okay, hello everyone. This is James Chen. Welcome everyone to this webinar brought to you by FXStreet.com. This is Finding High Probability Trading Opportunities in Forex. And today what I'm going to be doing is I'm going to be skewing this a little bit towards swing trading. And, we've seen a lot of swing trading opportunities recently in all the major currency pairs. So I'm going to be talking about that. So let's get started. By the way, for those of you who were at the New York Traders Expo just a couple weeks ago, I saw the gang at FXStreet.com, and if you were there, it was great seeing you. Okay, so before I get started, I would like to give you a quick important notice. Forex trading involves substantial risk of loss and is not suitable for all investors. The information contained herein is solely for informational purposes and should not be construed as trading advice. Just a few more seconds with that, and then we'll move forward. Okay, and also, before we get started, I would like to give you a quick overview of myself for those of you who are not familiar with me or what I do. I'm the Chief Technical Strategist at FX Solutions. My name again is James Chen. I've traded Forex actively pretty much since the inception of retail Forex, which has been, a little over 10 years now. I use primarily technical analysis, as many of you may know. I'm a Chartered Market Technician, or a CMT, which is a designation for technical analysts here in the U.S. and abroad. I'm also a Registered Commodity Trading Advisor, or CTA, registered here in the U.S. with the NFA, or National Futures Association. I publish daily and intraday analysis, including my chart of the day that you'll be able to find on FXSolutions.com, as well as FXStreet.com and many other places. I have a blog called FX Path that is on FXStreet.com as well. I've authored numerous articles in such publications as Forbes.com, Futures Magazine, Technical Analysis of Stocks and Commodities Magazine, and SFO Magazine. And just by the way, I have an article coming out in SFO Magazine for the May issue, so you might want to take a look at that. It's actually all about swing trading, which I'm going to go into in detail in a minute. But you could take a look at that May issue, SFO magazine. It's an online magazine. You could go ahead and go to sfomag.com to take a look at that. I'm also quoted on a regular basis by Reuters News, Dow Jones, Associated Press, International Herald Tribune, among many others, and I've authored 2 books, Essentials of Foreign Exchange Trading and Essentials of Technical Analysis for Financial Markets. And by the way, for those of you who are not aware, FX Street had these awards, the Forex Best Awards. I was very happy to have won first place for my second book, Essentials of Technical Analysis for Financial Markets, for Best Book. Thank you very much to FXStreet.com and all of you that voted. So that was very nice. I also have a DVD set called High Probability Trend Following in the Forex Market that's now available on FXStreet.com as well. Okay, great. Enough about me. Let's move forward. Now, I'm going to be showing you, I'm going to be talking about swing and range trading. Now, swing trading is one of the most common and effective methods used by currency traders in the FX markets. Now, it's often described as the middle approach, somewhere between long-term position trading and short-term day trading. Okay, so a lot of people will define swing trading in terms of the duration, and I'll talk a little bit about that. I don't think it should be described just in terms of duration of trade. There's a lot more to swing trading that that defines it better than the duration of trade. But essentially, we're looking to, as swing traders, we're looking to primarily exploit the many swings or turns that characterize price action in all major financial markets, including Forex, and we've seen lots of swings and turns occur lately in the Forex market. So it's sort of fitting that we talk about this today. Now, what is swing and range trading? The emphasis, once again, is on trading swings or turns rather than on the duration of trades. Now, there are many professional Forex traders that are swing traders. Setting risk and money management is relatively straightforward. So when you talk about when you're approaching the market from a swing trading perspective, it's very straightforward. I'm not saying it's easy, but it's very straightforward in setting your risk management, your stop losses, etc., because you have very defined areas that you could place your stop losses, etc. Because we're basically working off of support and resistance. I mean, swing trading is essentially support and resistance trading, which I'll show you in a minute. Now, it's a very active form of trading, as there are always swing trading opportunities in the currency markets. Ranges occur very frequently in the forex market, horizontal ranges or angled ranges. So when I talk about ranges, basically what I'm talking about are channels. So you've got your horizontal channels, sideways, up and down price action, but you also have the angled channels. And these angled channels are very popularly referred to as parallel trend channels. So whenever you have a parallel trend channel, you have a range. And in that range, you have many swing and range trading opportunities. Okay? Now, there's just one big difference between horizontal ranges and angled ranges. In a horizontal range trading situation, I will be just as likely to go long near the bottom of the range as I will be to go short near the top of the range. However, in an angled or a parallel trend channel, an angled channel, angled range, I am going to be biased in the direction of the trend. So, for example, if it's a parallel uptrend channel, we have a channel there. I'm looking to trade swings only to the upside. If it's a parallel downtrend channel, I'm looking to trade swings only to the downside near the top of the channel. Okay, so there's a big distinction there. But both of these, and you'll find horizontal ranges and angled ranges all over the charts. Pretty much any currency pair that you look at will often be either within a horizontal range or an angled range. And I'll show you that in a minute. Now, this can be used effectively on any currency pair, whether they're the major pairs, semi-majors. When I refer to semi-majors, I'm talking about, primarily Australian dollar against US dollar against Canadian dollar. The majors being euro dollar, pound dollar, dollar yen, dollar Swiss. And they could also be used effectively on the crosses and, even the exotics, although I tend to stay away from exotic pairs because of the lack of liquidity and also the very often wide spreads. Okay, now time frames are flexible when you're swing trading, anywhere from an hourly to daily and up. Smaller time frames, smaller than an hour, in my opinion, are more conducive to breakout trading as opposed to range trading. Okay? So, just a quick note on time frames. Like I mentioned, swing and range trading works on most time frames. The hourly, at least the hourly, but I often trade the 4-hour and daily. So hourly, 4-hour, and daily are my primary time frames to be swing trading. And another note here is that swing trading is not really about time frames or duration of the trade. It's more about capturing the market swings as best as you can within a ranging situation, whether that range is a horizontal range or an angled range. So I'm not saying, there are plenty of people that say, if you're a swing trader, you got to be in the trade between 1 and 5 days, or 1 and 4 days, or 2 and 5 days, or whatever it may be. There should not be any type of limitations on how long you stay in a trade. For me, once the swing is done, once you've determined that the swing is done, then you're out of the trade. Whether that lasts for a few hours, or that lasts for a few days, or even more than a week, then that's fine. So it's not about the duration of trade. It's more about capturing the market swings and letting the market tell you when to get out, not your determining beforehand when you're going to get out of the trade. Okay, so that ranges that occur on shorter time frames, as I mentioned, are usually more conducive to breakout trading rather than swing and range trading. Okay, so let's move on from there. Now, these are the criteria I use, and I'm going to give you a strategy that, a specific strategy that I use when I'm looking to trade swings in the market. And this is whether from a trend following perspective or during horizontal ranges. Support and resistance levels, number one. That is probably the most important aspect of swing trading, in my opinion. Support and resistance levels are key, and you'll often find that support and resistance levels are respected. And that's what we're looking for. We're looking for respect of support and resistance within the context of channels or ranges. Okay, number two, intra-channel trend lines. What I mean by this, and I'll show you a visual depiction of it in a second, but intra-channel trend lines are simply trend lines that occur within a channel. So if you have a horizontal channel and you have an up and down within that channel, then you're looking to draw, or I'm looking to draw, uptrend support lines, downtrend resistance lines, and I'm looking to play breaks of those as my triggers to get into a trade. Okay? Very simple. Bar and candle patterns. And there are many bar and candle patterns out there. Most importantly, the ones I use for this type of trading are two simple patterns. One is the hammer, the other is the shooting star. I'll show you a visual depiction in a second. But these two are extremely important to give me a warning that perhaps there will be a turn within a channel. Okay? They're just a warning. They're not my entry trigger. They're just a warning to tell me that. Okay? Also, you have multi-bar candle patterns and divergences, which when I'm talking about divergences, I'm talking about differences between price and the oscillator. I'll show you that on my charts in a minute. Those divergences are also used as warnings of potential changes within a channel and potential turns, and that's what you want to take advantage of. Okay. Also, not only that, we have oscillators. Oscillators, besides the fact that they're used in finding divergences, oscillators are also good in showing you when price is coming out of overbought or oversold. Okay, and I'll show you exactly what I mean in a minute. Also, you could use Bollinger Bands within the context of range or trend channel swing trading. So I don't often use Bollinger Bands, that much, but they can be used in that capacity. Okay. Now let me just explain to you this strategy real quick. I don't have this written down here. This is going to come out in the magazine article in SFO magazine in May, but I just want to define it and tell you a little bit about how I go about approaching swing trading in the Forex market. Now, basically what I'm looking for are three things. Number one, I am looking for a backdrop. What is a backdrop? It's a background. It's some condition that has to be there before I'm even going to think about getting into a swing trade. That backdrop for me is a channel. Okay, so you see up in front of you, this is a very simple channel, and up and down, up and down, up and down. Right? This is a horizontal channel. So the backdrop that I'm looking for is I'm looking for a channel, whether it be a horizontal channel or an angled trend channel. Okay. Number two, I'm looking for three potential turn warnings. Okay. So once again, number two is that I'm looking for three potential turn warnings. The first potential turn warning I'm looking for, and this is in no particular order, but I am looking for number one is a reversal candle pattern, and that's either a hammer or a shooting star. Okay, let me move down a little bit and show you this. Okay, so if you take a look here, I've got a hammer here. I show this all over the place. Some people don't know what a hammer or a shooting star are. A hammer is simply, after a down run, you have a small upper body and then a long lower wick. Okay, this is also called a pin bar. If you just trade bars, this is also called a pin bar, where you have a long lower line here with a small body to the upside. Okay, so this is after a down run. What does this talk about? Price rejection, price failure to the downside. You have a down run, price is trying to go lower, and then it comes all the way back to close near the highs. It got rejected to the downside, and preferably this area right here on the bottom is the area of support area. Okay. Now, shooting star is just the opposite. Shooting star occurs after an up run. You have this third candle here. You have price move all the way up, preferably towards resistance or right near resistance or at resistance, and then it comes all the way back down to close near the lows. So this is small lower body, long upper wick or upper shadow that occurs after an up run. What does this talk about? Price rejection, price failure at the highs. Okay? So, and a possible turn signal to the downside. So a hammer, once again, price gets rejected near support, possible turn signal to the upside. Shooting star, price goes all the way up towards resistance and comes down to close near the lows, possible turn signal to the downside. So that's number one, okay? Let me go back to my original slide here. Okay, so once again, I'm looking for three potential turn warnings, and number one is either a hammer or a shooting star, okay, depending on where I am within this channel or within this range. Okay, the second thing I'm going to be looking for is a divergence, a price oscillator divergence. And I'll show you that exactly what I mean on the charts. But I'm looking for price and an oscillator like slow stochastics or RSI or what have you to have a divergence, to differ. And I'm looking for that to tell me that there's possibly going to be a turn in the market. Number three, the third potential turn warning I'm looking for is for the oscillator, whatever oscillator I may be using, to be turning up from oversold near the bottom when price is near the bottom of the channel, or when price is near the top of the channel for the oscillator to turn down, crossing below overbought. Okay, hopefully that makes some sense. Again, I'm going to show you to you on the charts exactly what I mean. So those are the three potential turn warnings. Number one is a reversal candle pattern like a hammer or shooting star. Number two is a price oscillator divergence. Number three is for the oscillator to turn up from oversold or turn down from overbought. Okay? So those are my three potential turn warnings. I'm looking for at least one of those to warn, to tell me that perhaps there's going to be a turn within this range. Okay? So at least one, preferably more. If there are three of them, that's great. And I'll show you an example of where three actually do occur. Okay? So, number one is the backdrop, is a channel. Number two is one of three, at least one of three potential turn warnings. And the third thing that I'm looking for is an entry trigger. And what is an entry trigger? What do I use as an entry trigger? It's a simple breakout. Okay, so let me move down here. It's an intra-channel breakout. So as we can see here, we have a horizontal range here. Okay, I have these trend lines, downtrend resistance lines here. Okay, I'm simply looking for a break of these intra-channel trend lines to help me get into a certain trade. Okay, so it's very simple. That's my three, the three components of a swing trading setup that I'm looking for, and I'll talk about exits in a second. Okay, so support and resistance levels, we got the channel, and then this is my entry trigger, trend lines within a range. They may get you in later than if you had gotten in at the very bottom of the range, but for me, it's a higher probability trade because when you have a break of an intra-channel trend line, you have more assurance. Of course, you're never going to get anywhere near 100% assurance, but more of an assurance that perhaps a turn really did occur at support, or a turn really did occur at or near resistance, and there will be follow-through going towards the other side of the channel. Okay? Hopefully that makes sense. So I'm looking to play breaks of these, and I'm looking to possibly target the other side, or just shy of the other side of the channel. Okay, so that's intra-channel trend lines. As I mentioned, bar candle patterns. This is one of my warnings of a potential turn. Pin bars, or also known as hammers and shooting stars. Also, you could use multi-bar patterns like engulfing patterns, etc. That could tell you that perhaps there will be a turn near support or a turn near resistance. And as I mentioned, the price oscillator divergences. You could use MACD, MACD histogram, slow stochastics, what have you. Okay, and once again, these are the bar candle patterns. These two are of utmost importance, hammer and shooting star, at least for me, or for my approach to the market. And then you've got oscillator. Okay, now, once again, not only are oscillators used to talk about price oscillator divergences, but they're also good for talking about turns from overbought or oversold. Now, a lot of people will say that when an oscillator goes into overbought, at that point you should think about selling. For me, I don't think so, because if you take a look at any oscillator, price could be trending up for a long time, and the oscillator will stay within overbought territory for a long time. So it's really not good as an indicator in that respect. And by the same token, if you've got a downtrend that keeps persisting, you'll often find that the oscillator is staying within oversold territory. So when is that turn going to occur? So it's very, for me, it's very bad it's very non-productive to be using oscillators in that fashion. The way I use it, and it's only as a confirmation of turns, is that I'm looking for price to emerge from oversold or overbought to talk about a possibility of a turn in the market. So, for example, once again, if you're looking for a turn to the downside near resistance, I'm looking for the oscillator to cross down below the overbought line. By the same token, if you're looking for price, or you're waiting for price to turn up at support, at or near support, then I'm looking for the oscillator to cross up above the oversold line. Okay, that's how I use oscillators. Okay, and this is another one of my potential turn warnings. I use stochastics. You can use RSI, relative strength index, ROC, rate of change, or momentum, CCI, which is the commodity channel index, and I'll show you, a couple of those in a second. And what I just mentioned, I'm waiting for impending emergence from overbought or oversold, and also divergence. Okay. Bollinger Bands can also be used as confirmations of potential turns within ranges, although, for me, they're not as reliable as other indicators. Exits, and this is the last thing I'm going to talk about before I go to my charts. Exits are, you could, when you're swing trading, you can place your stop losses according to what the market is telling you. So basically, you're looking to place your stop losses, beyond support and resistance. Okay, so if you're in a channel trading atmosphere, for example, if you're trading near the bottom of the channel, then obviously the bottom of the channel, the support area, is a good guideline for where you might be able to place your stop loss, or a little bit below that. So as I say here, I would put my stop loss below or above the last swing. So below the last swing low or above the last swing high. And of course, you consider your reward to risk ratio. And when you're swing trading, the reward to risk ratio is very straightforward to calculate, because you know where your stop loss is and you know where your target is. Approximately, your target is near the other side of the channel. Okay. And then often what I'll do is I'm going to target the other side of the channel, but, price may be shy of that target before turning around and coming back. So I will, usually, at least pull my stop loss to break even, but also I might be able to trail my stop losses as well. Okay. So, in terms of profit targets, once again, the other side of the channel is a good, initial guideline. You could also let your oscillator, give you an exit signal. Okay, and when the oscillator reaches the other side of of overbought or oversold, and possibly you could also close out partial positions in increments when in profit. Okay, so that's exits. All right, so let me show you my charts real quick. Show you exactly what I'm talking about. I know that might have been a little bit confusing, but let me go ahead and show it to you. Okay, this is an historical example. This is a euro-dollar daily chart, but for me, this is probably among the most ideal examples that I could find. So that's why I wanted to show it to you. This is a daily chart of euro-dollar from a ways back. But anyway, if you take a look here, we have a channel trading. We have a horizontal type of channel. Okay. Now, once again, in a horizontal channel, what I'm looking to do is I don't have a bias to the upside or the downside, so I will, generally speaking, be looking for opportunities both up and down. So in this case, as you can see here, we have right over here, we have established resistance, okay, on this channel, on this horizontal channel. So what we have here, after we have this backdrop, which is the channel, I'm looking for 3 possible turn warnings. And here we have all 3 in their, right here. So if you take a look here, this blue line up here means that price made a higher high. Okay, this blue line down here on the slow stochastics means that the slow stochastics made a lower high or lower peaks. So once again, price made higher peaks, oscillator made lower peaks. That's divergence. That's where the price and the oscillator are differing. What does this talk about? Possible loss of momentum. Okay, loss of momentum near resistance. That's my first potential turn warning. Number two, what do I have here? This is somewhat of a shooting star candle. I mean, we have here this big red candle here, long upper wick. It got rejected at the highs. It got rejected at resistance, okay? And then a relatively small, this isn't the best example of a hammer here, but I'm sorry, of a shooting star. But nonetheless, we do have a very long wick talking about a rejection near the high. So that's number two. Number three, I have the oscillator here. As you can see here, not only is there a price oscillator divergence, I also have the oscillator crossing down below overbought. Okay, so that for me, three potential turn warnings. And then how am I looking to get in? I'm looking to get in on a breakdown of this intra-channel trend line. This is a support line right here. Okay, so a break to the downside, and then I'm looking to enter possibly into that trade. Okay, I have a better example. Okay, so right here we have an example here, and a lot of you may recognize this price action, but this was way back in the day. But anyway, if you take a look here, we have a very clear channel here. Okay, a clear horizontal channel. We have established resistance right here. Okay, so now once again, we have the backdrop. We have the channel backdrop. Now, what are we looking for? We're looking for three potential turn signals. Okay, what do we have here? We have price making a very significant higher high. We have the oscillator and the slow stochastics making a very significant lower high. Okay, higher high in price, lower high in oscillator, loss of upside momentum, potential loss of upside momentum. That's my first warning. Number two, I've got this great candle here. This is the Doji shooting star. Price action open and close near the bottom at around the same price, and but it has a huge upper wick here. Okay, meaning that price right at support was rejected. Okay, that's my second potential warning. Third potential warning, I've got the oscillator crossing down below overbought. In this case, on the slow stochastics, the 80 level, below overbought. Okay, so what am I looking for? I have my three potential warnings. I don't need all three, but I have all three. Okay, now I'm looking for a breakdown here. And this breakdown of this intra-channel trend line occurs, and then we have a big move to the downside. So that for me is a high probability trade. You have lots of conditions before you even look at this trade, and before you get into this trade, and then you have your trigger, and of course you have your risk management. So for me, that's a high probability swing trade. Okay. And in this case, it reached the bottom of the channel, as we can see here. Okay, same type of thing here. Let me just show you here, real quick. Same type of thing. I've got a horizontal range. This is pound yen. As you can see here, I've got negative classic divergence, higher high in price, lower high in the oscillator, and then I don't have any real good candle patterns there, but right at resistance, top of the channel, move to the downside, and then I have a confirmation of the slow stochastics moving down below overbought, a break of the intra-channel line, and then it goes to the downside. Okay? For me, that is a higher probability trade. Okay. Now, this is a very interesting one, and I just have one example on this one. This is an hourly chart of euro-dollar. It's relatively recent. Now, I have a uptrend channel right here. Okay, I have an uptrend channel right here on the hourly chart. So that's the backdrop. And then up here was a good example of a possible, long trade. And, if you take a look, I have CCI down here, the Commodity Channel Index. So what do we have here? We got a lower low in price. And once again, since this is an angled channel, this is a parallel uptrend channel, I am looking to only go long. At least for me, that's a higher probability trade. in an uptrend channel, I'm not going to, generally speaking, I'm not going to look to ever go short in an uptrend channel. In a downtrend channel, generally speaking, I'm never going to look to go long. Okay, I'm looking to trade with the direction of the trend. Of course, in a horizontal channel, it's different. You don't have a bias, so you could go up or down equally well. Okay, so what we have here, we have once again, I'm looking to go long. We have a divergence here. We have a lower low in price. We have a higher low in the oscillator, the CCI. Okay, that's the first potential warning. And then here we also have a move up above this oversold line at negative 100 on the CCI. And then we have an intra-channel downtrend resistance line. Break to the upside would have been a good opportunity. Okay. Okay. Same type of thing here. Dollar Canada. I have a rough channel, parallel uptrend channel here, and then over here I have as you can see here, the divergence, lower low in price, higher low in the momentum. In the oscillator that talks about loss of downward momentum, possible turn to the upside, possible impending turn to the upside. I've got a move up above oversold, as we can see here on the stochastics. Okay, and then I've got a break of this intra-channel trend line, a break to the upside. And that was that actually turned out very well. So that's basically it for my examples. As you can see here, this is in terms of let me just reiterate what I was talking about in terms of a high probability opportunities. It's hard to find a higher probability opportunity when you have so many conditions that need to be met before you get into a trade. And so once again, you need a backdrop, which is a channel, in this case either a horizontal or an angled channel. Number two, you need at least one of three potential turn warnings, whether it be a reversal candle pattern or a divergence, price oscillator divergence, or a move up from oversold or a move down from overbought. Those are the three, and then you have your entry trigger in your break of the trend line. Okay, and then beyond that, in terms of your exit, you could have an initial target, but also you could move your stop loss, etc. Okay, so let me see. I think we have a bunch of questions here that I'd like to take. Okay, what are the parameters of my stochastics? I tend to use stochastics a lot. I have 1433 is what I use, and that may be the default on some charting packages, but others may have different defaults. But I use 1433, and I have for many, many years. Okay. What time frames do you focus on for this? I showed you basically daily charts. So I'm usually looking at daily charts for swing trading opportunities, but also I did show you an hourly chart as well and a 4-hour chart. So I'm pretty much going back and forth between daily, 4-hour, and 1 hour. Jose, when do you start making your trend line? That's a great question. I start making my trend line. Basically what I'm doing is, if you take a look at any of my trend lines, I'm basically trying to connect at least 2 points. So in an uptrend, I'm trying to connect at least 2 lower points or support points. In a downtrend, I'm trying to connect at least 2 upper points at resistance. Now, basically what I'm looking to do is connect those and then see if it is respected on a third try. If it is respected on a third touch, then for me that is a pretty strong trend line. Okay, so the minimum is 2, but at the same time, you really need at least 3 or more to make a very strong and reliable trend line. Okay, so as you can see here, if you take a look at this euro-dollar chart, once again, this is an hourly chart. We have many different touches, at least 3 different touches here. But within each of these touches, we have a lot of respect of these uptrend, this uptrend line right here, this uptrend support line. So touches here, touches over here, and then finally where I saw that opportunity was on this third touch of support. Okay? Okay. Now, Jose asks, do you only look at divergence when the oscillator is within overbought and oversold areas or anywhere? You know, great question. When I'm looking at oscillators, I'm looking at only when they're within overbought or oversold. When they're in between overbought and oversold, then for me, it doesn't do me any good. Okay? Unless, and there are many people that look at the RSI as a trend following indicator. So, for example, in an uptrend, you'll find that, often you'll find that the RSI will stay, the bottom bounds of the RSI will not be in oversold territory. It's going to be well above oversold territory. Okay? Whereas when price goes up in an uptrend, it's going to go into overbought. Same thing with a downtrend. So if you have a downtrend, oftentimes you'll see that the RSI oscillator will not go into overbought territory. It's going to stay well below it. Okay? So besides that, though, I'm only interested in oscillators for when they're in overbought or oversold. Let me see. SW, can you talk about setting your targets for profits? Yeah, when I'm setting my targets, as I often mention, when I set my targets, I tend to have an initial target. I will always tend to have an initial target, and it's based upon support or resistance levels, further support or resistance levels. At the same time, however, I will not be, waiting for a target to be reached generally speaking, before I get out of a trade. I'm looking more for price to tell me when I should be getting out of that trade. Targets for me are a little bit arbitrary. You have built-in targets for many chart patterns, like, for example, the head and shoulders pattern or triangles or what have you. And there are some, there are targets for those. For me, those targets are a bit arbitrary. And for that reason, I will tend to de-emphasize price targets and emphasize more, locking in your gains and letting the market tell you when you should get out of that trade. Boyke, question, what are the differences between your first and second books? That's a good question as well. The first book it was basically talking about the foreign exchange market, and it goes into the technicals and fundamentals, and everything really geared towards the foreign exchange market. Whereas the second book, which was Essentials of Technical Analysis for Financial Markets, it basically went into more depth into the technicals, but for all financial markets. So it wasn't geared specifically towards the forex market. Rather, it talked a lot about strategies and technical analysis in general. Okay. Okay. It looks like we don't have many other questions there. Let me quickly turn over to my PowerPoint presentation. Okay, I don't have another PowerPoint slide to show you. So basically, thank you everyone for attending today's webinar. Let me just put my email address here, just in case you have any questions. Okay, so that's my email address right there. If you have any questions, please feel free to contact me at any time. And thank you once again, everyone, for attending today. Thank you.